The best S&P 500 ETF. Income versus growth versus taxes. We're going to answer it all today for you. Hey everyone, welcome back to the channel. I'm Doug, the Retirement Guy, with all your monthly ETFs. And that's right, today we're breaking down the S&P 500. We did this on the NASDAQ 100. We're now doing it with the S&P 500 to give you a comparison of the top 7 funds that we believe are really in the running for this category. We're going to look at the income side of it, the highest yield leaders. We're going to look at the growth side, which is the upside. How is it generating? And then we're going to take a serious look at the tax side of it, the tax, how each one handles taxes. We're going to give you that deep dive into each and every one of these particular funds. But before we do, I got to do a shout out to all of our 13,000 plus subscribers and our unbelievable, our Patreon group just continues to grow and grow, and we appreciate you, every one of you. If you're not part of it, go down in the description below, hit the button that says Patreon. You can sign up for free. There's no cost at all available. That if you want to help support the channel, be able to put this kind of information out, then you can always choose to through the Patreon side. Well, let's get into today's video, the S&P 500. Who is the best? We do have to do the disclaimer, and that is past performances don't guarantee your future results, and this information in this video is for educational and informational purposes only. I am not a licensed financial advisor. I am just one who's been studying this stuff for years. The example and suggestions discussed here are basically not suitable for all individual situations, so always contact a financial advisor before making financial decisions. Now, the S&P 500 ETF funds that we're going to compare, we're going to start off with is the NEOS, SPYI. We're going to go to the Goldman Sachs GPIX, JP Morgan's JEPI, the TAP Alpha TSPY, the Global X XYLD, iShares ISPY, and Amplified DIVO. Now, I know there's maybe some of you out there already saying, oh, what about this fund or that fund? But you got to make sure you stick within our criteria, which is one, they got to pay monthly. So if you have a weekly or a quarterly one that's out there that you like, unfortunately, we're not going to put that in because we're looking at monthlies and monthlies only. But you know what? Always leave a comment down below. I'd love to hear which funds that we missed or that we didn't think were made the cut. I'd like to hear what you have to say. But we also want to take a look at funds that have been here for over 12 months. So we can have some apple-to-apple comparisons over the past 12 months, how the funds have actually done. So we want to give you a dial into, and these, I believe, are the top 7 funds out there currently today. So we're going to try to choose one big winner. It's not just who creates the most, yield or income. We're not looking for who's going to be the biggest growth. We're not looking for who handles the taxes the better. We're trying to put this all in one big bundle to give you the best overall package across the board. So first, let's give you a little background. The S&P 500, the Standard & Poor's 500, is a stock market index that tracks 500 of the largest publicly traded companies in the United States. Now, it isn't just a list of 500 of the biggest companies by size, though. A committee chooses them to ensure that they represent the overall health of the U.S. economy across all major industries, tech, healthcare, energy, and so on. So why do we even worry about the S&P 500? What does this have to do with it? And why does everyone talk about it? Well, actually, it is the gold standard. It is considered the best gauge of how big business in America is actually doing. Diversification, by buying the S&P 500 through an ETF like VOO or SPY, you are instantly owning a tiny piece of 500 different businesses. And historic performance of it, long-term, 20 plus years, the S&P 500 has historically returned an average about 10% per year before inflation. So this is why you'll hear Warren Buffett always say, the simplest thing to do to invest, take your money, put it in the S&P 500 account like a VOO or SPY, and sit back, relax, and don't even listen to anything else. Well, he's kind of right, But a lot of us are now looking at this saying we need income, we want different things out of the funds, and that's where these ETFs have come from. So let's start off with the yield challenge. Which S&P 500 pays the most? The income that we're looking at. Now, on this channel, I always tell everyone right up front, we don't just chase yield. But unfortunately, a lot of people look at yield and they make a decision at this point in time. This is the fund for me because it's got the highest yield, it's got the best overall, and that's just called yield chasing. So let's break down each one of these funds. So let's take the yield information. Now, the latest yields percentage for the top 500 funds. Now, let's start at the bottom. And the lowest one comes in actually is ISPY from iShares. Came in at 4.83%. Kind of low for this fund when the S&P 500 is kind of cranking out a 10% total to only get 4.83. Then we go to Amplified, 6.46% from DIVO. Our next one, GPIX from Goldman Sachs, 8.12%. Now we're talking a little bit serious, more numbers. We're closer to that 10%, which I know we're not going to achieve because of, that their total return is 10% and the S&P 500 is built for growth. This is why these funds are designed. They're built for income. So we can see we're closer to the matching of the S&P 500. Now, breaking into the top 4 is going to be JEPI, the JP Morgan. Now, this is a fund that's been out for years, and this is a fund that's almost like the gold standard in retirement funds. JPI has always been the fund in place, cranking out at 8.38% of yield. Now, our top 3, where do they fall? Well, at number 3, it is going to be XYLD, the Global X S&P 500 at 10.56%. Very impressive number when the S&P average, like I said, is 10%. This one's now above that point. So we're down to our final 2 at NEOS, SPYI, or TAP Alpha, TSPY. Can you guess which one it is? I'll give you a second to think. Now we're going to show you. Number 2, SPYI, NEOS, S&P 500, 11.83%. Now, personally, I own probably 5 out of the 7 funds right now I personally own. And SPYI, I hate to say, is probably one of my favorite packages. But I was shocked that I'm finding out that TSPY is actually breaking the bank and going well over by almost 2.75 percentage points. TSPY, TAP Alpha, has done a phenomenal job of getting the higher yield across the board. Now, does this mean we put all of our money into TSPY? Absolutely not. This just tells us currently what the yield is. What is their distributions payout compared to the price of the fund? Now, TSPY, of course, we know it's around that. Don't hold me to this, but it's about a $25 to $27 price fund, while SPY from NEOS is more in that $50, $53, $54 range. So that can change the difference in yields across the board. So number 1, TSPY. Number 2, SPYI. And coming at number 3, XYLD. Now, let's move over to growth. Because most of the time when we're looking at these funds, we do want a mixture of income and we do want some part of the growth. So which one's going to give us the most growth? And it's funny, So let's take a look at the growth information that we have currently. Now, growth is an important part of every portfolio. So where does it come into? And I'll give you a second here to judge out which one you think is going to be the number 1 winner across the board. So starting off at the bottom, we'll come in at JEPI. Now, this is a funny one here. This is a fund that's in a lot of retirement accounts that a lot of people have in their retirements. The problem you have is this yield is only 1.51% for growth. So you get it's built for income, not as much for the overall growth of a particular fund. Now, coming in at number 6, XYLD from Global X at 5.09%. Kind of a difference there. As they were in the higher level with income, they're now at the bottom of growth. Then we get into SPYI from NEOS at 9.70%. Very respectable number compared to the other two, but you can see right off the bat where yield means one thing, growth is another thing. So you normally don't have a fund that's in number one in both categories running across the board. Then we get into TAP Alpha at 9.95%. So you can see our number one fund in yield is not our number one fund in growth. It didn't even make the top three. But at 9.95% plus the income that it's generating, both NEOS, SPYI, and TAP Alpha both show some very, very potential long-term winners across the board. So let's take a look. Where are we at? Number 3. And that's going to go from Amplified DIVO at 12.07%. So you can see this one's built more for the growth side than it was on income. Now, our bottom two. Is it going to be Goldman Sachs or is it going to be SPY from iShares? The answer is GPIX comes in at number 2 at 16.33, and ISPY comes in at number 1 for the biggest income at 18.48%. So if you're looking to grow your portfolio, if you're looking for more growth than you are income, here we are. Here's the funds to take a serious look at. The number 1 being the iShares, the number 2 being the Goldman Sachs GPIX, and number 3, DIVO. Okay, so this is where you want to put your money? Well, when you take a look at a standard S&P 500, who really has no real income, they're all built for growth, and they have an actual 10% per year average. Well, our top 3 all beat the 10% of the S&P 500. Now, why did they do this? Well, this is why we do the videos after this of each one of these. We break them down tremendously. We show you what the good, the bad, and the uglies are across the board. And to give you the information, well, each one of these operate differently with those covered calls and doing it, to generate the income and help increase their growth. Total return. Now, this is the number that I personally live by. Total return information. This tells me what's going on with a fund. And this total return is basically total return captures the income plus the growth for real total results. I see a lot of times people see big yields and they think they're making big money, especially in the weeklies. They see that they're making big money. I'm making 30, 40, 50% numbers. And then when they take a look at the NAV erosion or they take a look at the growth side of it and it's in negative numbers, you're really not getting true hardcore numbers. This is why total return is the most important piece. So when we get into total returns, this again is the income and the growth put together. So it gives you a better idea of where each one stands. So coming in at the bottom of the barrel will be JEPI at 10.28%. So as a total return, again, using that 10% base off of the S&P 500, it comes in and qualifies well. And you can see why so many people put it into a retirement fund, that it did have some good, strong income, didn't have much in the growth, but a 10.28% total return is what we're working on. Next, we get into Global X XYLD at 17.08%. Then we move to DIVO, 19.69%. Again, another fund that is heavily into the growth side of it, not so much on the income side, as JPI is the opposite. It's heavy income, little growth. So those are two funds that actually, I always say you could work those two together. One giving you income, one giving you growth, and work them together in a total package. Now we're in our top 4. Who will make the top 3? Well, nut number 4 is SPYI. Now, I know a lot of people are going to say, wow, I cannot believe this. at 23.80%. SPY filled in at number 4 as a total return. Now our top 3. SPY, iShares Core, 24.70%. Who will be the winner? It's GPIX or TSPY. Coming at number 2 is going to be GPIX, 26.67% total return. And of course, TSPY comes in at number 1 at 26.89%. Now, I know a lot of you are saying, well, hold it. NEOS is a better fund. They're a different fund. Well, total return numbers at 23.8 is where they really settled into. We're talking about a 3% difference from TAP Alpha to NEOS SPYI, which has been the leader over the past 12 months, has really been one of the big leaders. But when TAP Alpha stepped into the plate, it's been a challenge getting to that next step. So how do we rate it? Do we rate it by yield? Do we rate it by growth? Do we rate it by total returns? Well, you can see TAP Alpha's got to be number 1, right? And Goldman Sachs got to be right in there at number 2. But this just gives you how a funds can generate both income and growth and work together in one package. So TAP Alpha 1, Goldman Sachs number 2, and iShares at number 3. Now, how do they handle the taxes? This is a big question a lot of people ask. And this actually is a piece of the puzzle that adds more to it. I'm going to start off with and just go right down each one of them. The NEOS is actually uses the 1256 contracts, which gives you that 60-40 long-term, short-term blend. So 60% of your distributions are taxed in long-term capital holdings, 40% short-term. So that means you're paying less money into that side. And the other side is they do also add in a little bit of ROC, which is return of capital, to help reduce it even more. Goldman Sachs is all return of capital. So it's a higher percentage classification of ROC. Amplified DIVO is qualified dividends. Most qualified dividend income, QDI, is coming out of the DIVO side of it. So again, that's going to reduce your tax burden. JP Morgan, ELNs, is ordinary income. You're going to pay this like regular income from JPI program. You're going to pay regular taxes. Now, a lot of this is going to relate to what portfolio you put it into. If it's a brokerage fund or a Roth IRA or a regular 401k or standard IRA, these will mean a lot to you. Now, TAP Alpha actually uses what they call a synthetic exposure, which is going to give you the potential of the ROC. So that it's targeting higher yields, and the tax efficiency descends on specific option structures that they use. Now, Global X uses standard covered calls, which gives you standard ordinary income with short-term gains. And then iShares is the S&P 500 index option that gives you that 60-40 that we talked about with NEOS. So when we look at these things here, iShares and NEOS really are top of the barrel when it comes to handling taxes. This is another piece you have to use when you're talking about total returns and total packages, how does it handle taxes? Now, some of you will say, I put in a Roth, I don't worry about that side of it. That's great. But if you have in a brokerage fund, we need to look at this stuff and have some serious things to it. So TAP Alpha, the TSPY, was our winner across the board with total returns, but does not handle taxes for retirement packages or taxes as a whole. They use ROC. Now, if you don't know what ROC is, return of capital. So what they say is a certain percentage of the distributions, sometimes can be 100%. I've seen some as low as 2%. Will come back to you and say this is return of capital. So what it does is actually reduces your cost on paper till when you sell them, you're going to pay your taxes at a higher rate down the road. Now, hopefully you hold them longer so you can get into the long-term category of capital gains. But the positive is NEOS gives that to you right up front. So my real winners here is going to be the NEOS SPYI and the iShares ISPY. And then we're going to get into the rest of them that are kind of really into that same game, which is going to be the TSPY, and the DEVO and the GPIX, because they're using ROC or qualified dividends. So you're, again, trying to reduce as much as you have to pay in taxes. Now, unfortunately, the two that look the worst is going to be JEPI from JP Morgan and the Global X from XYLD, because they're just ordinary income added to you paying whatever tax rate you're falling into, you're going to pay accordingly. So there's give you your winners are there. Now everyone always talks about this when I put it on the screen for a reason, is expense fees. Is it because it's a number that people can look at, but I don't know if anyone really understands that all your returns, all the numbers I just showed you, have all this included into it. So when you take a look at someone paying you a 10% distribution, or how it works out, these numbers are already been subtracted from that. So when someone tells me that they're looking at expense fees, what's the expense fees of this? Has some importance to it, but it doesn't always factor into when you look at the yields, total returns, and the growth side of it. Now, here's what we get into. The lowest fund across the board is the Goldman Sachs GPIX. Definitely enjoy that at 0.29%. JP Morgan comes in at 0.35. Very strong, very two companies that you see a lot in retirement funds because of the reduced expenditures. Why do you want to spend money to keep things rolling when you don't need to? Then we get into the DEVO and the ISPY at 0.56. And then Global X, Tap Alpha, and NEOS, all right in their categories. So overall, yeah, you have some lower fees, but right off the bat, we've shown you JPI is good for income, didn't do much in the growth, was at the bottom of the barrel for total returns, but you are at the total lowest expense ratio. So who is the king? Guys, I'm putting it out there right now. To be honest with you, I'm not taking the highest total return. I'm not taking the highest yield. I'm not taking the highest growth. The best overall performer in my eyes is SPYI from NEOS. Now, I'd love to hear a comment from you below. You can be yelling at your screen right now. Put a comment down below. What do you think? I believe SPYI is number one because of it does have very strong yield, has a very comfortable growth, has a comfortable total return. I'm not saying it wins any one of those three categories. I don't think it really won any of the categories, but it came in relatively close in the top. I think overall was always in the top 4. But the taxes is what makes me push SPYI first, because the way they handle their tax package, which is overall I think is the best program. And then they have a good yield, a good growth, and a great total return. So you guys can argue with me, because the next one I use is GPIX. Okay, that came in at number 2 to me. The yield is definitely lower, 8.12. The growth is higher. And I believe I put number 2 on GPIX because of the growth. If someone's looking for growth, this is probably the number 1 fund. Kind of leaning towards it, because you can take that yield, drip the yield into it to increase your growth even more. This is why this was so difficult to do. It was such a major setup across the board. At number 3, TSPY from Tap Alpha. Hands down, that thing had the overall best yield. It does have an equal growth to SPYI. It does have a larger total return, but it's the tax handling of it that's been wrong. Okay, if they could fine tune that from an ROC, because ROC is one that can cause that NAV erosion. It can cause some hiccups down the road. And I just kind of said, look, we're going to put that at number 3, because I just think more safety is in SPYI. Now at number 4, ISPY. And you see the thing at the middle, I put that a key matchup, SPYI versus ISPY. Those two, I'm telling you, we're head, all the way through in our research and what we looked at. And it comes down to is you want growth versus income. And I'd like to have a little bit of both. And I just thought SPYI had it because of the yield and the 9% growth versus only the 4% yield and the 18% growth. Again, what are you looking for in your portfolio? Everything is here to give you exactly what you're looking for. And of course, number 5, DEVO, number 6, XYLD, and unfortunately for me, number 7 is JEPI. It didn't handle the taxes properly. The yield is 8% is okay, but their growth is going to eat into the yield, which will eat into the total returns if they don't get that 1% growth. So guys, there's my top ones. That's the king of the S&P 500 is SPYI. Let me know in the comments below if you agree, if you disagree. I read every one of those comments in there. I'd love to hear from you, and let me know your thoughts.
Thank you for watching. Press the